Right, so there's a lot of movement out there, of course, in rates right now. We're seeing a lot of conversation happening around what the Fed is doing, what the Fed's going to look to do as we continue over these next few months as they continue to fight inflation. That conversation is going to lead a lot into our investments and how we're looking out into the future here. So ultimately, we have to look at the properties we're taking on and just the risk profile. So with so much uncertainty now over the next 6, 9, 12, 15, 18 months, when we're taking on opportunities, we want to find loans that help us weather the storm for the next 3, 4, 5 years. We don't want to be in loans where short term, they will allow us to get into the deal, but then within the next 12 or 24 months, we'll have to find a takeout loan. It puts us in position and puts us at risk of just so many uncertainties in the market as we've seen over the last 2, 3, 4 years here. So we want to see how can we get some fixed rate or a floating rate here with a cap to limit our really downside exposure. So as you're looking at your investment now, you look at the risk profile. What is the potential case for worst case scenario, right? You can look at your base case, your worst case, and your best case. And you want to know that your worst case can be capped, that if all things go wrong, the cap there gives you the most advantage or most options to pick a good exit strategy to allow yourself and your investors to still have a good deal in your hands. So as you look forward here, say, okay, fixed rates or floating rates. There's a lot of data that actually shows that floating rates have outperformed on a 5 and 10-year horizon. Well, why is that? It's because sometimes the word from the Fed is, we'll say, more scary or actually does more impact than the actual results of what they do here. So the built-in effect of what is happening now for fixed rate loans is that we're paying more for that fixed rate, because it's built in based on the expectation of what the Fed will do. The floating rate adjusts basically as things continue to happen here and is going off SOFR right now on the most part, or Wall Street Prime, as an indicative measure of really what's happening out there in the market. But if the worst of it has already been said by the Fed and they retract from where they're going, they take off their hawkish approach and back off from there. Well, if we've already taken on rates that have that built-in risk to them, already built into what we're paying, we ultimately over the 5 or 10-year horizon may be paying more for that loan compared to if we had a fixed rate loan out of the gate, even paying slightly more. So looking at your deal, looking at the risk profile, looking at the downside risk to that deal, where am I exposed and where would my investment and my investors exposed? That's your best way to look forward and say, what kind of loan would be best to put us in the best position to win, not only today, but 2 years, 3 years, 5 years from now. All right, happy hunting.